Welcome to the Property Buyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Welcome to another edition of the Property Buyer Podcast. Today we're joined by one of Australia's most respected housing analysts, Cameron Kusher. Cameron has spent years analysing credit cycles, demographic shifts, supply pipelines and price movements across every capital city. He's known for cutting through the noise and focusing on what the data actually says, not what the headlines suggest. Cameron was formerly the Executive Manager of Economic Research at REA Group and the Head of Research at CoreLogic, and he's now the Director of his own company, Kusher Consulting. In this episode, we're going to unpack the real drivers behind Australia's housing market. We're going to look at borrowing capacity and interest rate movements, household formation and rental pressure. And we're going to explore where the current risks are in the market, where the opportunities lie, and what serious buyers and investors should be watching over the next 5 years. Cameron, welcome to the Property Buyer Podcast. Great to have you on.
Yeah, thanks for having me, Rich.
Look, I've been wanting to have a chat with you for many years and often see you at different events, so it's really great to have you on. But before we dive in, we've got a tradition on our podcast where I'm going to throw you a philosophical quote, and I'd love to get your perspective on that, if that's okay. And today's thought of the day is from Anne Frank, who says, "How wonderful it is that nobody need wait a single moment before starting to improve the world." What do you take from that quote?
Well, I think the quote's, it's a great quote, and I think it's probably a bit relevant to me. Not that I think I'm improving the world, but, not having a moment to wait before starting to improve even yourself. And I guess over the last 12 months, I've started my own consulting business, something that I never thought I would be doing. But, at some point in time, you've just got to dive in and start working towards something different. And I think it kind of definitely resonates with me.
Good on you. I think a lot of people kind of blame the government for things or saying the environment's, going to crap and it's like, well, pick up a piece of rubbish, start your own company like you've done. Good on you, mate. And that's hats off to you. Starting your own business, it's a great journey and you're going to learn a lot. So I hope you
definitely will.
You will. I know you will. Karen, before we get into the data, I've just got one other personal question, if I may ask you, and that's really curious to know why you decided to be a property economist. What kind of sparked your interest in the property market in the first place?
I think my interest was sparked in the property market by the fact that my parents bought an old Queenslander. I live up in Queensland, and we were constantly renovating the house. Every weekend we were moving bricks around or doing whatever. And I think that built a desire in me to have a house that was finished and I didn't need to do any work with. But I think it definitely piqued my interest in property. When I was at high school, I worked on the weekends at the local Harcourt's real estate office.
Awesome.
And then I went and studied property economics at university. I thought I wanted to be a property developer, but I worked for a property developer who wasn't a great developer. They ended up going out of business. And but I'd always been interested in statistics. I used to buy the footy cards and memorize the stats of, how many tries someone scored. So I'd always kind of liked numbers and remembering interesting statistics. And then I ended up going and working for PRD Nationwide up here in Queensland, getting a research manager role, and been doing it ever since and really enjoy it. And I think I'm really passionate about taking quite complex ideas and issues and making them very easy to understand for anyone. I do find that a lot of people that work in analysts or economics roles. They speak very high level. They talk in a lot of jargon, and it's just not understandable for most people.
You would have made a great lecturer at uni, Cameron. Like, I mean, I did economics. I did a master's as well in economics. And I just remember some of my finance lecturers, and it's like they talk in this highfalutin language. And you know, what the hell did that guy just say? But then there were other tutors that were brilliant, and they translated into really simple concepts. And that's where I really got economics like you. I've got a really keen interest in the data and the numbers as well. So fascinating to hear your story. I love the fact that your parents are right into it, and you've seen some real experience out there. That really brings a different level of credibility to your advice too. Having seen that on the ground, it's great. Yeah,
so, definitely.
Cameron, I'm curious. Let's kick off with the credit cycle. Let's have a look at where interest rates are at. And I'm just curious to look back over the last 5 years. How much of the price growth that we've seen post-COVID has been driven by borrowing capacity, i.e. lower interest rates, or versus genuine demand? Can you make any distinctions there?
Look, I think both of them have definitely been a driver. I mean, through COVID, we saw interest rates reduce to the lowest level they'd ever been. But we also saw a lot of changes. People were working from home. You didn't necessarily need to be in a capital city anymore. You could do your job basically from anywhere. So I definitely think it's a combination of borrowing capacities increasing as interest rates fell, but also more people wanting to have more space. Those lower interest rates obviously helped a lot of people enter the market who were already renting. And then our population growth has been very strong as well. So that's driven demand for housing as well, not just from owner-occupiers, but also for people wanting to invest, because they know that rental demand is really strong and hasn't been met, and we haven't seen new housing supply keep space. So I think they've both been factors. What I would say is obviously borrowing capacity has reduced over the last couple of years as interest rates have been increased, but we've continued to see really strong demand for housing. It's been a bit mixed. We've seen weaker demand in markets like Melbourne and Victoria, Tasmania as well, but we continue to see very strong demand in places like Southeast Queensland, in WA and South Australia.
Interesting. So just on that theme of constriction on borrowing capacity, like we've had one interest rate in February this year, another 0.25. Like, do you think if we get another rate rise, how much more constriction is there going to be on borrowing, do you think, in the next couple of years?
So every time interest rates change, whether that's up or down, you reduce or increase your borrowing capacity by about 2.5% to 3%. So, the interest rate hike we've had has reduced your borrowing capacity by about 2.5%, which is not a huge amount. But I think what interest rates do, it's a signal. So I think if we do get another interest rate increase, and then the commentary from the Reserve Bank remains quite hawkish that we may see further interest rate hikes, then that will probably cause some buyers to second guess whether or not they should be buying in the market. You can also see that, longer term bond yields in Australia have edged higher as well. So for people that look to take out fixed term mortgages, the cost of those is going to probably increase as well. So look, one interest rate change one way or another doesn't make a huge difference, but it's what the expectation is going forward from there that can really impact on borrowers, both in terms of their mindset, but also on the cost of borrowing, especially if you're going to go to fixed-term borrowing. Yeah,
you're right. I mean, one of the slides that I always put up in my presentations is that Melbourne Institute Westpac consumer confidence chart, and confidence is a big thing in the property market, and interest rates up or down have quite an impact on people's psychology. But then they've got the real factors like the actual interest rate or, APRA's serviceability buffers and debt to income ratios. Do you think that people are underestimating just how much impact, DTI, debt to income ratio and serviceability buffers are having on future constraints? And do you think APRA might loosen or tighten regulation at some point?
So the serviceability is obviously a big one, because you're looking, whenever you get assessed for a mortgage, they're assessing you on your ability to pay an interest rate 3% higher than whatever the rate you're offered. And, yes, we saw interest rates rise by more than 300 basis points during the pandemic, but it's pretty rare outside of the pandemic that would increase that much in a cycle. So that's certainly having an impact on people's ability to borrow money. the debt to income constraints that they announced late last year, and I think they're going live, or they have gone live in February. I think that's a pretty limited impact on the market insofar as if you look at debt to income ratios above 6 times, they're still only about 6% of all lending. I think what the idea of that is to pull back some of the lenders that are very aggressive in that space. I feel like also that DTI constraint that they brought in was kind of a warning shot. If we see lending quality deteriorate, potentially if we continue to see investor lending escalate as rapidly as it still is, then that may be a reason for APRA to come in and make some further changes. I don't know that they can make the serviceability buffer any wider, but we've seen in the past that they've limited the growth in investor lending. We've seen in the past that they've limited the use of interest-only borrowing. Obviously, more investors use interest-only than owner-occupiers. Yeah. And I think that's possibly what they could look to do again.
Interesting. And there's some commentators out there that say you can't have rising interest rates and increasing property prices coexisting. I say you can. What's your thoughts on the coexistence of rising rates and rising prices?
Well, you definitely can. Interest rates aren't the only factor in house prices, but they're certainly a fairly large factor given that most people that are buying a property use leverage. And if you're taking out a loan, your interest rate's higher, then that can lead to less ability to pay higher prices. But I would say just look at what's happened over the last couple of years. We saw the cash rate go from basically nothing to 4.35%. And we continue to see prices rise. Now, they didn't continue to rise everywhere. We saw a little bit of a pullback in markets like Hobart, Melbourne, Sydney, and we saw the rate of price growth slow elsewhere, but prices were still rising, in southeast Queensland, in Adelaide, in Perth and Western Australia. So you can still see prices rise with higher interest rates. But what I would say is it's likely that any rises that you get as interest rates increase is not as rapid as they're going to be when interest rates are falling and interest rates are lower.
Yeah, really good point. It's the rate of growth that is going to be dampened, and then obviously there's a tipping point to that as well. So I loved your key point. You absolutely nail it, and is that there's many more factors than just the interest rate that's going to affect the price, the property market, which leads me to my next point, which I really want to get into, which is just talking about the supply constraints, right? So we see there's a lot of discussion in the media about the housing accord, and just the constriction in supply. But, the supply issue is not terrible everywhere. It's certainly fairly widespread. But I was going to ask you, do you think that do you think dwelling completions are actually keeping pace with household formation? Are we actually getting enough approvals through the system to keep up with the changing demographics in our society?
Generally not. But what I would say is if you actually look at the ratio of population growth to new dwelling completions, they're above their long-term average pretty much in every single state, but they're at about a similar level to household formation in places like Victoria and New South Wales. They're well above. So we're not building anywhere near enough in markets like Queensland and Western Australia. But really, estimating the undersupply of housing really depends on when you start, and you can get a different result on our housing undersupply depending on when you start. But if you look over the longer term, before the pandemic, we were building more houses than we needed based on population growth. We certainly haven't. I think one of the challenges, though, at the moment is the type of supply that's being added to the market. So, 4 or 5 bedroom houses, that's always been a big part of the supply, particularly on the outskirts of the city. But if we look at the apartment market, a lot of the supply there has shifted from being smaller 1 and 2 bedroom stock to now being larger 2 and 3 bedroom stock targeted at the owner-occupier segment. And I'd probably argue single households or single person households is the most rapidly growing demographic at the moment, and we're probably not building enough housing catering to that demographic. Now, not every single person household is just going to want one bedroom. Some of them are going to want one bedroom and a study. Some of them are going to want two bedrooms because they want a spare room. But we're not really catering to that end of the market at the moment when we talk about new housing supply.
Interesting. Yeah. And I guess looking forward the next sort of 3 to 5 years, do you think we're going to get the same rate of approvals? And I think you mentioned, in terms of we are tracking fairly close to the long-term average, but the issue in my head and what I see on the ground is that we get the approval, but then it's not feasible to build because construction costs are so high. Construction costs have risen anywhere from 40 to 60%. So it's all well and good to get a DA, but no developer in his right mind is going to build it because they'll go out of business.
No, that's the biggest challenge facing property developers at the moment. I think it's one of the real shortcomings in the access to data that we have here in Australia, because everyone focuses on building approvals. What they don't realise is, there's a material change of use that often happens with a site before that. Then you get your actual development application lodged and you get that approved. We're only measuring building approvals with official data, which is when someone's got pre-sales and is ready to go. There are a huge volume of properties that have got their development application approved, but they can't get the pre-sales they need, or the project's just not feasible enough to even try and sell it at the moment, so it doesn't go ahead. But it's a real blind spot because that's just information that's not collected by the Australian Bureau of Statistics, and it's not freely available. But look, I think we'll probably see a little bit of an uptick in supply over the next couple of years, but the 1.2 million new homes over 5 years for the housing accord, we're going to fall well below that. I mean, that's 60.
How far short do you think we're going to fall by the end of the
I reckon it's probably 250 to 300,000 short of that target. Keeping in mind that the target originally was 1 million, and then the Labor Party upped it to 1.2 million. And the other thing to keep in mind is it was supposed to be well-located properties. We can argue whether some of the new housing supply is well-located or not. But we're going to fall well short of that. And, a lot of people will go out there and say, it's the planning system, it's this and that. The reality is that housing construction moves in cycles. And when you've just come off a period where construction costs have gone up 40%, when interest rates are the highest they've been in about 13 years, that's not conducive to a cycle where you're going to get strong construction. The other point I'd make to your listeners there is, for most developments, you actually need prices to be rising to encourage developers to bring stock to the market, because the higher prices makes a new project more feasible. If you look at somewhere like Victoria at the moment, price growth has really been depressed, and that's going to limit the viability of new housing because, developers take on a significant risk when they go and do a new project, and they want to be remunerated for that risk. And they'll typically look for a margin of 20%, knowing that it's probably by the end of the project not going to be 20%, but it still might be, 12 or 15%, and they're making a decent profit. But if they can't get that 20% margin to start with, then it's just not going to go ahead. Most developers I talk to, Cameron, won't touch anything under 25% because there's always 5% contingency minimum. Like, no developer I know would get out of bed for 12%. It's just way too much risk. They can make money other ways. So again, it just comes down to a risk reward. So it's all well and good to have a housing accord and policies, but at the end of the day, as you say, it's getting the right incentives for all parts of the system to make it happen. I just want to pick up on a point you just raised about, the types of properties that are, or property types that are being built, and we're not building enough of them. So what as we look in the future, the pipeline of supply, we've got apartments, townhouses, and then houses, just the general three. But you're saying we're not building enough of the smaller stuff. Is that typically what you're suggesting? Well, I think we're not building enough of everything, but I think it's in terms of the apartment supply, a lot of it is larger owner-occupier, and that's targeting a lot of people that are downsizing out of big family homes. But, there's a finite level of demand for that product. What we know that there is good demand for is a smaller 1 and 2 bedroom product that's bought by investors, rented out, or it's bought by first home buyers that want to be located in a really good area of the capital cities. So we're probably not doing enough of that. I think in terms of townhouses, we're definitely not doing that because it's a nice middle area between, okay, I can't afford a house in a location that I want to be in, but I don't want to necessarily be in an apartment. I want to have a bit of grass. I want to have my own space.
Yes.
Again, the feasibility of townhouses is really challenging. And then house and land, that's the backbone of housing supply. Most people in Australia still want a house. Most people are willing to move to the outskirts of the city to get that. But you need to have enough of it zoned. You have to have enough of it without constraints on the supply of that. And even in some of our larger regional markets that are connected to the capital cities, there's just not enough house and land, not enough land approved to deliver the house and land that we need. I mean, you think even about places like the Gold Coast, there's virtually nothing at the moment coming down the pipeline on the Gold Coast. There's very little supply in Wollongong, areas like that. So it's not just about house and land in the capital city, although that is problematic, but it's also in some of these larger regional markets where people want to live and we're just not getting enough of that stock becoming available.
Yeah, really good points there. Cameron, I want to talk about investor behaviour, particularly since COVID. I love tracking data over many, many periods of time, and I love the charts you used to produce at CoreLogic showing, the ups and downs of the market, but generally the ups, the downs are very short, and just all the different things that happened, like a GFC or, tariff wars, whatever, right? And property prices just is so resilient. But do you think investors are behaving differently since COVID and since the rate rises? Are you seeing any different behaviour there from property investors?
Well, I think firstly, we're not seeing investors very active in the new housing space. Now, a lot of this, I think because it's more expensive. And yes, when you buy a brand new property, there's all sorts of depreciation benefits you get. But I think in most instances, the gap between the price of a new home and an existing home is so wide, particularly in markets like Sydney and Melbourne, that investors just are finding better opportunities with existing properties. I think the other big shift that we've seen since COVID is investors are looking for opportunities outside of the major capital cities. People realise that there's a lot of regional areas in the country and that there's a lot of opportunities in a lot of those regional markets. There's a lot of investment going on. There's obviously a lot of people that have moved out of the capital cities to those areas, and investors are looking at those opportunities beyond the traditional capital city borders.
I think those regional markets too, they're much more affordable. And
yes,
some of those regional markets you need to be really careful of because there might only be one or two economic drivers for employment, but there's some fantastic regional cities. I mean, I can talk about some of them, but, Geelong or Townsville or Newcastle, Newcastle's Australia's seventh largest city. Very diverse economy. So those markets have really been quite resilient and quite strong, got a really good future. So I think a lot of investors used to be scared of these regional markets, hearing horror stories about prices declining, like in Port Hedland or Karratha, where the market just dropped, Actually, I often joke to other people about how all the spruikers used to come to me and say, Rich, get your clients to buy these off-the-plan apartments in Karratha. I said, how much are they? $1 million, but you'll get 15% yields, and sure enough, 2 years later, Cameron, guess what happened? The value of
it dropped.
Exactly, dropped to 400 grand. It would have lost 600 grand in capital value for what? So the risks of those markets was just off the charts, So
I do think for a good 10 or 15 years, people were really burnt by what happened in those markets, and I think people are still very wary of mining towns. But I think that people are discovering that in a lot of parts of regional Australia, there are some really diverse economies, and there's some good opportunities there. And in a lot of those areas, people that have to go there to work won't necessarily want to put down roots and stay there forever, but they're happy to rent for the 5-10 years that they're working there.
Exactly. They're not just FIFO workers. They are doing exactly a 5 to 10 year stint, And you made a really good point just about the established versus new stock. We buy 99% of the properties we buy for our clients are not brand new. They're established properties because the value differential between an established property and a brand new is significant. You're paying a developer's margin when you're buying a brand new property, where you're buying a much more closer to land value and a small improvement on the land when you're buying an established property. And I just think that's much better value longer term. I want to ask you too, just what you're seeing in the data about yield sensitivity versus capital growth expectations. Like, what are investors going for? What's the data showing in terms of yield and capital growth expectations? We appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now, let's get back to the podcast.
I think in most markets, your yield's not strong enough to cover your costs. So we're not getting those opportunities that we had for a period there where, cheaper to buy than rent in a lot of areas. And the places where it is cheaper to buy than rent are places like mining towns that you probably need to be wary of. But there are some regional areas where there's really strong yield and you're getting some decent capital growth as well. I think it really depends. I mean, in capital cities, I think people are more inclined to invest for the capital growth potential, and maybe even some of those larger regional markets, places like Newcastle, places like Wollongong, the Gold Coast, areas like that. But you get a little bit more regional than that, and that's when it's more of a yield play. And look, there's some good opportunities there. And I think people just kind of look at the gross rental yield and go, it's 4%, it's 4.5%. It's not good enough. But it's like, well, if you buy now, if you buy at a good price and rents continue to escalate, then in a couple of years, that yield could be 5.5%, 6%.
Exactly.
And that's probably what people need to be thinking a little bit more about, not just what it looks like now, but what it's going to look like 2 or 3 years down the track.
That's an excellent point, because a lot of people have very short-term thinking, expect it to be all perfectly lined up with a silver bow on the top to say, you're going to get a 5% yield right now. But as you say, if you're getting, rental increases per annum on 4 to 5%, like we've been getting the last couple of years, we even saw 9 and 10% yield rental price increases, so it's soon going to get back up to the level that you need to get it at. You just got to nurture it for that short period of time,
Yeah.
Cameron, let's talk a little bit about, we mentioned about the single person households before, and that's one segment of the market that's probably the most rapidly growing. But how is that the rise of single person households impacting demand, and are planning policies keeping up with this kind of shift?
Well, it obviously impacts demand, because if you've only got one person living in a property, you need to deliver more properties than you would if you had, 2.5, 3 people living in the market. And I think this comes back to the point that if we look at a lot of the new housing stock that's being delivered, it's house and land, which is, as I said, the backbone of supply, and what we always need to focus on, because it gets delivered quickly and it caters to those families that want that type of product. But increasingly in those inner city areas, we're not getting enough of this 1 and 2 bedroom stock that's really well price pointed. And a lot of that is due to the fact the construction costs have increased so much, and that stock just isn't feasible anymore. But I think planning policies need to certainly keep up with that shift, and we need to look at ways that we can deliver that product both in high-rise apartments, but also are there other alternatives like townhouse product? Most of the townhouse product you see is, 3 or 4 bedroom. Is there an opportunity for 1 or 2 bedroom style townhouse product that's really well price pointed? I guess the other point to make is we need to have enough land zoned for higher density in our inner city areas, and not just inner city areas around train and public transport to deliver that stock. We've seen quite a change in markets like New South Wales and Victoria, where they're trying to upzone a lot of areas around train and public transport. But again, upzoning is only part of the challenge. The projects have got to be feasible. And you go and talk to developers in New South Wales and Victoria, and they say, the upzoning is great. It means we can build higher density, but the project just doesn't stack up anymore.
Exactly.
And I think people keep repeating this. I don't know that government's getting the message, and I don't really know exactly what they can do. I mean, when you're adding more people to an area, you've got to upgrade infrastructure, you've got to, provide more schools, you've got to do all this sort of stuff. So there's a real cost to the local community. But I think that the governments, the local governments and the state governments really need to be working a lot more closely with developers and trying to understand how they can make more of this product feasible and bring it to the market sooner.
Yeah, really good points. Cameron, I'd love to tap into your perspective nationally now. I want to ask you sort of more about some of the specific capital cities. And firstly, just want to ask why you think Brisbane has outperformed Melbourne in the last couple of years.
I think the lockdowns in Melbourne really harmed that state. What was it, the longest lockdown in the world? It was more than 300 days that they spent in lockdown. Look, I think that encouraged a lot of people to leave Victoria. At that time, Brisbane, if you were leaving a relatively nice part of Melbourne, there was still a massive advantage in moving to southeast Queensland because you got probably, if not a better location than what you would have got in Melbourne, probably in most instances a better location than you got in Melbourne.
I reckon a lot of them have got PTSD. When I speak to a lot of Melburnians, they go, the lockdowns were draconian, and they've still got, still start shaking when you talk about poor things, so that's terrible. Right?
Yeah. Oh, look, I was very glad I didn't have to live through something like that, but I think that's different. And I think the other thing is, somewhere like Brisbane, and I've always lived in Brisbane, I think after the pandemic, there's more of an opportunity to live in Brisbane and have a job that's basically a Sydney or Melbourne job. Even if you're on the Gold Coast or Sunshine Coast, you can jump on a plane. Yeah. You can go down to Sydney or Melbourne for 2 or 3 days a week. Yep. Then you can come back and you can work from home, or you can work in the local office in southeast Queensland. And I think businesses have realised that, but also people have realised that, and they're willing to make that trade-off. Okay, maybe I need to fly every week down to Sydney or Melbourne, but I get that lifestyle that I want. But
it's interesting you just mentioned, and jump in there. It is about the lifestyle and the mobility of jobs. It used to be the fact that if you were moving from, Sydney or Melbourne to Gold Coast or Brisbane, you take a pay cut, right? Because the jobs were just not offered enough. But I've got, even my own staff have moved to Brisbane, and it's working perfectly. Like, you can have that remote working. It doesn't work as well, but it still does work. And I think there's been a lot of people who've gone, you know what, I'm just fed up with this ridiculous not having a lifestyle. I'm going to move. And and there was always chasing the dream of living in the Sunshine State. So
yes, exactly. Although, to be honest with you, as someone that lives in Brisbane now, it's hard to find good value in this market. I thought you were going to say infrastructure.
It's hard to find a car park. Is that what you were going to say?
Yeah. No, I wasn't going to say that. But the infrastructure is very strained. You're definitely noticing it travelling around the city that there's just the roads are clogged, the public transport's clogged. It's and this is a problem we're seeing right across the country, that we've got this rapid rate of population growth, and our infrastructure investment's just not keeping pace with it.
Yeah. Every time I go to Brisbane, though, it's a fantastic city. I just think it's just around the city area, the foreshore areas, it's just a really attractive spot to live. So it's no wonder people have moved there. But equally, I think Melbourne is also, in my view, undervalued at the moment. What's your opinion of the price point of Melbourne? And do you think it's structurally challenged, or do you think it is undervalued? What's your thoughts on the Melbourne market going forward?
Oh, look, I think it's genuinely undervalued. I think the challenge in Melbourne at the moment is that there's quite a lot of stock on the market, and we know that the Victorian government's made some changes whereby they've made it less attractive for investors, and I think that's the thing that's really impacting on the market at the moment. But overall, Melbourne's going to be the biggest city in the country in the not too distant future, and I think that prices realistically should be higher than they are in places like Brisbane, Perth, Adelaide, and other parts of the country. But things are just depressed because of what happened during the pandemic, and the fact that there's so much choice in the established market for buyers at the moment.
Do you have a view of the recovery time frame? Like, obviously, if there's a big COVID hangover, but is it like from this point, like we're recording this in the beginning of 2026, is it going to be a 2-year recovery, a 3-year, a 5-year, 10-year? Like, do you have any view on, getting the median price of Melbourne back to used to be within about 30% of Sydney? Like, it's sitting at about $1,080,000 at the moment, and it's in Brisbane's higher. But what's your thoughts on the time frame for recovery?
Look, it's hard to know the time frame. Again, I think it really comes down to when that excess supply of stock starts to be consumed or come off the market. So I think it's still probably a few years away, maybe 2 to 3 years away. But I think when that recovery happens, it's going to be a pretty strong recovery in prices across the city.
Yeah, got it. And give us a bit of a snapshot of some of the other capital cities, please. So maybe you start with Sydney. What's the prospects for Sydney going forward? How's it been performing and what's its future looking like?
I mean, Sydney's not shot the lights out in terms of price growth, but it's seen pretty steady growth. I mean, the challenge in Sydney is just that it's already such an expensive market that people's ability to break into that market, if they're already not in it, is extremely challenging. But look, I think Sydney will continue to see price growth. I don't think it's likely to be the best performing market in the next few years, but I think it'll probably still see steady growth, maybe slightly above the rate of inflation. If we look at a market like Perth, for example, Perth's been absolutely shooting the lights out in terms of its rate of price growth over the last few years, and demand in that market is still really strong. I think the really similar thing between Southeast Queensland, Perth, Adelaide and Darwin is that there's very little established stock in those markets, and you've got quite a lot of people wanting to buy, and those are the conditions where you get really strong price increases. Mm-hmm. I'm always a little bit wary of Perth because, you know, it is a bit of a one-trick pony town, and people in WA won't like me saying that, but so much of the WA economy hinges on iron ore and other resources. I'm always a bit wary there, and it does look a bit late cycle, but in saying that, I think it's probably got some further price increases to go just because that stock level is so low. Adelaide's somewhat similar as well. Adelaide's trying to diversify its economy and do a little bit more, but the appeal of Adelaide was always that it was so affordable. Now, compared to Sydney, it's still affordable, but compared to the rest of the country, it's not really that affordable anymore. But again, very low levels of stock on the market. Adelaide could be somewhere like Southeast Queensland where, you can have a Melbourne job or you can have a Sydney job and you can be in Adelaide, jump on a plane and go back there if you need to. So I think, again, it's still got some price growth to go, but probably not at the same magnitude as we've seen over recent years. The Darwin market's an interesting one. We know that investors are absolutely piling into that market at the moment.
I just feel like it's a Ponzi scheme at the moment, to be honest with you. Tell me your thoughts, right?
Yeah, look, I probably wouldn't be jumping in now. I think that every man and his dog is saying go and invest in Darwin, and a lot of it's just been purely that yields are quite strong now. There's quite a lot of infrastructure investment going on in Darwin at the moment, and I get that. And we know that it's a really transient population, so a lot of people that work there don't want to live there long term. They're just going there for a job. And I think, prices will probably rise going forward for a bit longer, but I would be a bit cautious about jumping into that market now, given that every man and his dog seems to be doing that. And then if you go to somewhere like Hobart, for example, look, Hobart's really cheap. Hobart's, good value for money. It's a great lifestyle down in Tassie. But there's some structural issues there. If you're looking to move there as a young family, the school system's not the greatest. Access to childcare and GPs is certainly not the greatest in Tasmania as well. But some beautiful properties there and really well priced. If you've got that flexibility to live in Hobart and get paid a Sydney or Melbourne wage and you're willing to travel, there's some good opportunities there. The rental vacancy rate in Hobart at the moment is extremely low.
Very low.
But there's actually quite a lot of stock on the market in Tassie at the moment as well. So it's an interesting one. There's seemingly not enough rental stock, but established stock for people to buy as owner-occupiers. There's quite a lot of that at the moment. But, for $1 million, you get some pretty good quality housing in Hobart. In a lot of instances you'll get water views or water glimpses. So that's really attractive. And probably the other market we haven't touched on is the ACT in Canberra. Steady as she goes. They manage housing supply there quite well, but there is quite a lot of housing, established housing stock on the market in the ACT at the moment. And that's probably one of the things that's resulting in that slower price growth.
And just before we move off the sort of national system sort of discussion, are there any particular metrics you think that buyers, both home buyers and investors, should watch to spot early movements in the property cycle in any of these capital cities? Is there any particular bit of data you'd be looking at?
Oh, the thing I always try and watch is what's happening with listings. I think that really gives you an idea. It's hard to really measure demand, but if you see listings dropping, that obviously means that, and dropping quite quickly, that is an indicator that, that demand is picking up and that supply is not responsive enough. The other way to look at that is also, your time on market. What's happening with your time on market? Is it reducing? Is it increasing? And also the level of discounting happening in the market. When more properties selling at above the price they're listed for or below, for me, those are the most telltale signs about what's happening in the market.
Yeah, perfect. So just want to quickly touch on the rental market. Do you think we've had some pretty low vacancy rate numbers across all the capital cities? I remember back in the day it used to be, 3 or 4% was sort of considered the norm. Now we're seeing, Brisbane's at 0.9%, Adelaide's 0.7%. You mentioned Hobart, I can't remember what the number is there, but are we in a sort of a different sort of cycle for rental market figures at the moment for vacancy rates?
It seems like it because, the longer term people say, the average, a balanced market is sort of 2.5% to 3%, but we haven't been anywhere close to 2.5%, 3% for quite a long time. Vacancy rates in markets like Sydney and Melbourne and Canberra are certainly a bit higher than they are elsewhere. But structurally, I think we are challenged because we're not building enough new investor stock. Secondly, if we look back to the second half of the 2010s, we discouraged a lot of investment. We limited investor credit growth. We limited access to interest-only loans. And we're probably now suffering the consequences of those actions now that we've got this structurally tight rental market. And at the same time, we've got very strong net overseas migration to Australia. And that doesn't also take into fact the number of temporary students we've got here in Australia as well. And, most of the people that are coming to Australia don't own a property. They need somewhere to rent. And we just don't have enough of that supply. And the way you get that supply is you build more, but in order to build more, you need a lot more people investing in residential property to make those projects feasible. So it's almost like we cut off our nose to spite our face. Investors are viewed as these bad thing that we don't want. We want more people to own properties, which I don't disagree that we want more people to be owner-occupiers, but there's a lot of people out there that just aren't in a position to do that. And in order to cater to that, we need more investors making new investment projects feasible.
That's it, exactly. Just one last quick question on listing volumes, and I've often asked Tim Lawless as well, your colleague in the industry, about this, and asking why we keep seeing listing volumes trend lower every year. I think the Cotality numbers at the moment, we're down minus 18%, the 5-year average. Why are we seeing this trend year on year of the lower volume of listings? What's going on with vendors?
I think it's becoming sort of this self-fulfilling prophecy that people have made a lot of money, particularly if you, again, Southeast Queensland, Perth, Adelaide, and they probably want to sell or they've outgrown their home. But it's this case that, okay, I can sell my property, no worries. I know I can do that. I can get a good price for it. But there's actually nothing else available for sale. So where am I going to move to?
So Mexican standard things, right? So you can sell, but you can't move anywhere, right?
Yeah, and then you've got extremely tight rental vacancy rates as well. So, okay, I'll sell my house and rent. And it's like, all right, well, but where am I going to rent? My kids go to school here. I don't want to move them out of school. Maybe we're moving to the other side of town. I don't want to move them to another school and then have to move them again. So I think obviously the rental vacancy rates, we focus on the challenge that is for renters, and it's a huge challenge for renters, but a lot of people that sell a home also need to pass through the rental market, and the tight rental market is making it really challenging for them. So I just think that people are kind of frozen. They know they can sell, but they've got nowhere to go if they will need to rent, and they've got nothing to buy if they want to purchase. And at some point, it's almost like someone's going to have to bite the bullet. And we did see these conditions in Sydney and Melbourne sort of 2022, 2023, and then people just started getting on with it. We started to see listings increase, but it hasn't happened in those other markets.
Yeah, interesting. I want to just turn our attention, if I may, to market risks. Are there any kind of, X factors on the horizon, Cameron, that you think would cause the market to get the jitters and see price falls? Do you think unemployment's going to be the trigger? Are we going to see another crazy Donald Trump announcement of, 200% tariffs? What are the risks on the horizon in your view the next 3 to 5 years?
Look, I think the biggest risks are the global risks. It's always, it's always those black swan events. I mean, look at the GFC, look at the global pandemic. They weren't things that people foresaw. When it's a risk that we can see potentially coming, I think we're pretty good at managing those. Obviously, if unemployment spiked higher quickly, that could be a trigger. But I already thought that the unemployment rate would get by now to higher than it is, and it's still sitting at 4.1%, right? So the labour market is extremely tight. For me, I think the biggest risks are always those unforeseen risks.
Yep.
I don't know what that could be. Again, it could be globally, it could be domestically. But if I knew, I'd be trading on that, but I don't know what they are. But I think they're the ones that really have the biggest potential to knock the housing market off its course.
Well, I think the message for listeners here is to always be prepared, a bit like the Boy Scout motto, right? So have a buffer, make sure your tenants are locked in at a good price. Talk to your bank about extending your line of credit or whatever. So be ready to take advantage of those times, because I knew for me during the GFC was one of the best times to buy property, during COVID when I was freaking out. Again, another great time to buy property before it all took off. So you do the Warren Buffett, approach, go counter-cyclical, right? That's always the best way, but don't get hammered by that. You don't want to be over leveraged and have 15 developments going at the time when construction costs are going up 25% again.
Exactly.
Yeah. So Cameron, you're a data nut, right? So what are the most commonly quoted metrics that are misleading? What sort of data points do you think are commonly talked about that you think maybe mislead consumers?
Oh, look, I think people don't really understand what a median price is, and I think that's probably one that's most misunderstood. I mean, median price is the middle number of every single property that's sold over a period of time, and I think that a lot of people just look at the growth year to year and don't realise that median price growth can really be distorted by compositional change. So if in 1 year, if you're looking at median house price, it was all 3-bedroom product, it was it was the lower quality stuff that was mainly selling. And then the next year, you've got higher quality 4 and 5 bedroom stock. You're going to see a big jump in price, but it's not actually representative of the whole market. It's just that there's been quite a shift in the composition of stock that's changed hands. And I think the other big one is auction clearance rates. We look at those and they certainly can mislead. I mean, a lot of the metrics don't look at properties that withdrawn beforehand. It's not necessarily a complete view of all of the auctions. It's only what they can collect. And I think that they certainly something that can mislead people as well. But I think some of the most commonly quoted data is the ones that potentially people don't understand as well as they should.
Can we just go back? Because that's a really good point about median prices. So let's take a suburb like Cannon Hill in Brisbane and let's say Double Bay in Sydney, right? So let's do Double Bay first. I haven't got the data in front of me, but let's say the median house price is like, $6 million, which is probably about what it is at the moment. But let's say in next year that no units are sold. This is totally hypothetical, right? Let's say no units are sold, but in fact, there's a whole bunch of really big sales around, 10 sales at $20 million. And the media is going to have a field day saying, look, median prices have gone from 6 million to 20 million in 1 year. It's like a 220% increase in house prices. And then equally in Cannon Hill, basically no houses are sold, just all units are sold, and they're sold at pretty much the same price or even less than what they were last year. And we're seeing a decline in the market. And then the following year, a reverse happens, right? So what I'm trying to point out is, as you say, the composition of the stock changes. So just elaborate a bit more on my example. I probably didn't articulate it quite clearly, but I'm trying to get the message across. You know what I'm trying to say?
Yeah, I think the thing you need to understand is exactly what a median is. And if you're looking at the growth over a period of time, to dig a little bit deeper, so go back 12 months ago and have a look at the type of stock that was selling and then compare it to what's selling now and make your own judgment. Is that a like-for-like property or are we seeing fundamentally different properties selling between two different periods? And then that will be the way that you can better understand whether the median price is actually truly representative or not.
And it's better to look at it over a 10-year period. If you take exactly that 3-bedroom house in Cannon Hill, back in 2016 versus what it sold for in 2026, that's going to give you a much clearer indication of longer term or potentially future capital growth rather than just short-term median price fluctuations.
Exactly.
Cameron, you've been a font of knowledge today. I have one more question just to finish our podcast with you. I'd love to get your outlook, I guess, the next 3 to 5 years. Just maybe generally give us your base case scenario, upside scenario, downside scenario. Where do you think generally the Australian property market's going to go the next 5 years?
Look, I think it's generally going to head high, but I think what we're going to be seeing is a more volatile interest rate market. And I think interest rates are not going to head back to the lows that we saw during the late 2010s and obviously early 2020s. And the greater volatility. So that means there's going to be more periods where interest rates are rising. They're not just going to be trending lower over time. And that, as I said, interest rates aren't the only factor that drive prices. But when interest rates are increasing, you do tend to find that prices rise at a slower pace. So I think that the outlook for the next 5 years is that prices will rise, but they won't rise as rapidly as we've become accustomed to. That's probably my base case scenario. Upside scenario would be if interest rates fall further than expected and don't rise any further, then we probably see a stronger period of growth. And then the downside is if interest rates if inflation remains problematic and interest rates remain higher for longer, then we'll probably see weaker price increases, and we might actually see prices rise at a pace below the rate of inflation. I think the other, obviously the big thing is we're not building enough new housing, and we're not going to hit that housing accord target. But if the government could actually look forward to the next 5 years after the current housing accord period and start making plans and changes to make new housing more feasible, if we do get more supply, then that will obviously also probably lead to slower price increases across the market.
Exactly. Yeah, I think we are going to see a situation of more moderate growth, and I think investors need to bear that in mind, but also to be patient and hold for the full cycle, take advantage of the good times, the down times and the tough times, and ride it out. So, Cameron, you have been a font of knowledge, as I've said. Thank you so much for being with us today on the Property Buyer Podcast. Just to tell us your company name, please, and your company website if people want to get in touch with you.
Yeah, thank you. So thanks for having me, Rich. And my company website's just kusherconsulting.com.au. And if anyone wants to get in touch, please feel free. Offer consulting services and a range of other services, but you can have a look on that website and it'll give you an idea of what I'm up to.
Fantastic. Well, thank you again for being with us, and thank you all our listeners for being another edition of the Property Buyer Podcast. Again, please reach out if you do have any questions or interest in buying properties at our website, propertybuyer.com.au. We'd be delighted to help, and please stay in touch. We'll be having some fantastic webinars coming up and some more education events and more podcasts, so stay tuned. Thanks for being with us on another Property Buyer Podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer Podcast.